All right, so today we're going to further clarify our approach where we rent our clients' retirement accounts, or use this approach where we, use the analogy that we're going to rent the investments in your retirement accounts just as you would real estate. So I've got the whiteboard here. I don't know what that is. We'll start over. And I want to just kind of further clarify here and make that comparison between renting real estate and what it means to rent your investments in your IRA. So the first thing we're going to do is we're going to say, let's draw the line here and have the comparisons between real estate and your investments. Okay, so on one side we'll have real estate, and I'm just going to put IRA here, since most of you understand what an IRA is. Maybe you have a Roth IRA or something like that. Now, in real estate, we all know the process. I'm not going to spend a lot of time on it, but we get the idea that at some point you're going to buy a house, right? If you like to invest in real estate and you get this concept, you're going to buy a house, and let's say that house costs you $200,000. Okay? So you've decided you want to invest. You're going to find the house that you think produces the best income, that you can get the best rents from, and in the best neighborhood, of course. We all know the real estate game. There's no need to spend a lot of time on it. Now, when you buy this house, the $200,000, that's your cost. Whether you pay cash for it, or you have some kind of loan, or you put half down, I don't know, whatever you do. And from this point, the house that you have here may need a new roof, it may need some carpet, I don't know, you may want to do something to make it look more attractive so you can command that higher rent. But a $200,000 house in this neighborhood, let's say this produces $2,000 a month in rent. Okay? So the idea is really, really simple. You own it for $200,000, you hope to collect $2,000 every single month in rent, and whatever that difference is, whatever your costs are, let's just say the costs are $1,000. Between a mortgage that you may have, any expenses that you have in there, maybe you pay a property manager to manage that property, and you end up with $1,000 net. Now I'm using really easy numbers because that's good for me. Okay, so this is very clear. We all understand this. The goal would be that the value of this house over time is going to go up, and your rents, of course, are going to go up over time, and hopefully the net amount that you take home is going to go up. But every single month, you've got this $200,000, and if you were to put all of it towards that, your cost basis is going down. Let's just say you didn't take any of the money yourself, you just put it all towards the house, your goal was to pay it off. Now, over time, you're going to work the cost of this house down while the value hopefully goes higher. As long as it wasn't 2009 or some weird year where real estate took a big hit, over time you're going to be just fine. Now, what are some of the negatives here? If you buy real estate, there's a few little hiccups that could happen along the way, right? Someone could choose not to pay the rent. There could be months where the house sits vacant and there are no available tenants to rent that house. They could damage your house, right? You could end up with a house that started off really, really nice, and somebody gets mad at you, and over time they set the house on fire. Okay, that was pretty stupid. But you get the idea, right? The house starts in a condition, and you hope that that person that's renting it, or the people that rent it from you, take good care of it so that you can keep working your costs down and the value can keep going up. The point is, it's not a straight line, right? We all know we're going to have evictions, we're going to have months where the house is vacant. That's going to be a problem. Now, take that same concept, okay? This same approach that you grew up understanding. Everybody knows the idea of renting a house. And now we're going to go over here and say, hey, let's pretend we do the same thing with the investments in our IRA or our long-term holdings. Here's the difference. You don't own just one position in your IRA. You're going to have many positions. Now, some of those positions could be like a total stock holding, where you have the S&P 500. Maybe you have some NASDAQ I'll use because that's one that we all know. There's a D in there. You might have other investments in there that you prefer, single stock positions. I'm just going to put stock, something that you're attracted to, Facebook, Dell, or not Dell, Facebook. It could be Ford, it could be any stock that you just personally have an attraction to that you feel like you want to own in your retirement account. That's okay too. A lot of people have gold in their retirement accounts. It kind of acts as a form of a hedge, but it's also a long-term investment that many people really believe in. And now with exchange-traded funds, you can actually own gold, physical gold, without actually keeping it in your house. We could also have some oil. And then typically there's some kind of bonds in there. Short-term, long-term, something like that. Okay, so whereas you might buy one house with $200,000 in the retirement space, in the market, there's not a chance you would pick one investment and hope for that to just go up over time. So if we took the same $200,000 and we invested it in our IRA, or we have these holdings in our IRA, of course, we're going to be diversified. We're going to have things that interest us. We're going to have some market exposure, some kind of hedges, some commodities, and some bonds in there. You don't have to have all of these, of course. It's just as an example. Now, in your IRA, remember, like we do here at Jazz Wealth, we pretend that these are all houses. So I'm not going to draw a house over every single one of these, but you get the idea. We're going to pretend that these are houses. Gold will be some house here that we have, and you get what I'm trying to say here. Each one of these represents a house. It's just an analogy. It's just an approach that we use here. Now, just like rental properties, we can actually go and rent each one of these out to people. You see, you're going to hold these for the long run. You really have no short-term goal with your retirement account. If you're in your 40s, in your 50s, whatever, you plan on just hanging on to these. We don't make active trades inside of your retirement account. Studies have proven that that's just not beneficial. You're better off holding for the long run. Now the question is, would you ever invest in real estate and not rent the property out and end up with no income? You just have your $200,000 cost basis, and you hope that over time the value of that piece of real estate just goes up, and that's it. You don't want to see it go down. The goal is just to get it to go up. Of course not. You would never ever buy a piece of real estate and leave it vacant. But for some reason, we're taught that the investments in our retirement account, we're supposed to buy and hold forever. Now, it's a great approach, right? In the long run, you're going to be just fine. But while we're holding these forever, could we treat them like real estate? And the answer is yes, absolutely. The biggest investors on the planet are doing this every single day. If you watch CNBC for more than 5 minutes, somebody is talking about doing this. Now, they're using the technical terms. They're assuming that you understand what all of that means. But essentially, they're talking about renting out the positions in your accounts. Not always retirement accounts, but in general. Now, taking a look at this over here, not all of these will go up when the market goes up. So if we're focused on the S&P has some path that it's going to follow. If you go back 9 years, it's been pretty much a straight up path. It's been doing really well. The NASDAQ has outperformed. So it's done a little bit better than the S&P. Lately, it's doing a little bit better as well. Now, whatever the individual stock is, we don't know if that's going to keep up with the market. That's just something that you're interested in. So let's say that that goes up a fraction of an amount versus the market. But you like it, it's your stock, and you want to hang on to it. Now, gold typically does not go in the direction of the market. It typically moves in the opposite direction, not one for one, not a perfect one for one decline, but every time the market moves higher, typically gold moves a little bit lower. So look at this, all of a sudden we've got a little tug of war here, okay? Now, for now, we're gonna say oil's just flat. We're gonna say that the oil is just wiggling around. It's down a little bit at the moment, but let's say for the most part, it's just gonna kind of wiggle around while the markets do whatever they're gonna do. And bonds, typically bonds move in the opposite direction of the market, right? So what do we have here? Whereas over here we have a piece of real estate that is only able to go up or down. That's it. We've got the one property. It either gains in value each year or it's going to decline in value, right? In the long run, it should be just fine. Over here, we have some stocks and some stock exposure moving higher. And then we've got some other stuff that's tugging. It's pulling a little against our portfolio. That's okay. There's nothing wrong with that because remember, when the markets go down, these are all going to flip directions, right? For the most part. It's not perfect. Don't hold me to that 100%. But it's not a perfect one for one. Now that's great because you never want to be committed your full $200,000 in one direction. The real estate guy over here, he's committed in one direction. If the value of a house goes down, what's he going to do about it? Nothing. In 2009, 2010, and so on, the value of real estate was going down with the market. There's nothing you can do. Now, if you're renting it out and you're getting that the $2,000 a month or something like that, okay, well, you see the value of your property is going down, but your rent could be going up, right? So there's that game you can play, and there's no exact science to that. We just know that, hey, at least I can rent it out, I'll get some money, and I'm in this for the long run, so it's okay. Over here, we can do the same thing. For the S&P 500, we can get you $300 a month. Not an exact number, this is an example. To say, hey, we're gonna get $300 a month here, we're gonna get $300 a month here. I don't know what this stock is, so we'll just say it's $200 a month. Not every stock, by the way, can be rented out. All the popular ones, the big names that you've heard of, no problem, you can do that. But for the most part, if it's some unknown name or some penny stock, I can't help you with that. Now gold, while we're waiting, we can say we'll take $200 a month. Oil, $100 a month. Oil's a little trickier. Sometimes we don't get the highest rents over there. And then bonds are not very exciting either. We'll say you get $200 a month. Okay? Now all of this goes into your account. This is not some scammy thing where I'll steal all this money and you can do all this. This is all yours. You get to keep this. Real estate, if you own real estate and you were coming to me saying, hey, manage this for me. Go ahead and get the best rents you can. Help me pay off this house. I'd be like your property manager. Over here, this is your retirement investments. I'm a registered financial advisor. I'll go out and get those rents for you and let you keep them. So I'm kind of like your your IRA property manager. So now I'm doing the work to make sure you're getting this income here. Now what happens? Just like in the real estate, you have some cost here, right? This S&P 500 investment, it costs you something. Now remember, you started with $200,000, so you split this money up somehow over these investments. So there's a cost, and each month, this $300 you get to keep, and the next month, $300, and so on and so on. And so while the value of this you hope continues to go higher, not too fast, just a nice, easy sort of incline there, you're gonna get to keep this rental income and it's just gonna keep coming in. That's my job. I'm the property manager of your retirement accounts and I'm gonna make sure you get that rent. All the way through the investments. That's what I do for our clients. Each and every month I go through and I make sure they're getting some kind of rental income. What's the difference between the two, right? So where's the disconnect? In real estate, there's damages that the tenant can have. Of course, there's maybe they don't pay the rent. Maybe there's some upkeep, some extra costs. In your IRA, the tenant, or quote tenant, pays the rent up front and on time every month. There's no chance that they won't pay that rent. Every time we go and rent this out, the money goes into your account and it stays there unless you change your mind. And you're not going to change your mind because you're going to hold all these investments. The tenant never touches your investments, so they actually can't damage them. And everything's electronics these days, so there's not a chance that they're going to tear it or set it on fire or something's going to happen. So that's the difference between the two, right? It's a little bit safer over here because you don't have a physical thing that can be taken from you or burned down or whatever it is. Now there's one catch, okay? There's one catch to all of this here, and that is that when somebody rents these investments from you, they have the right to buy it from you. Have you ever owned a piece of real estate, you rent it out to somebody, and after a couple years or something, they come back to you and they say, I love this house. You know, we've lived here for so long, we know it inside and out, we know it's a good house. Would you be willing to sell it? Right? That happens. People ask that question. The difference over here is every time you rent it out, we're gonna agree to a sales price up front. And so the person that gave you the $300 a month for the S&P is gonna say, maybe this costs you $100 a share. They're gonna be on contract, written in stone, to say, I'll buy it from you for $103 a share, okay? And you have to agree to that. Now there's nothing you can do after that. Once you agree to that, if the person wants to buy it for $103 a share, you have to say yes. Even I can't say no. If they come to me and say, I'm renting your client's S&P and I would like to buy it from them, I have to let them have it, okay? So there could come a point where you're collecting rent, and somebody says, I want to buy it from you. And all of a sudden it'll disappear from your account. You no longer own the S&P. But just like in real estate, the very second that they do that, we're going to turn around and do it again. Right? There's not a limited number of homes that you can buy. So if someone decides they want to buy it, we'll take that profit, we'll let them have it for the price that they were willing to pay, that we agreed upon, and then we're going to redo the exact same thing. Now look, I know this is maybe a little bit complicated. I use the analogy just to make it easier to understand, okay? I'm the only one that's actually saying it like this, so I run the risk of people thinking that there's some catch or there's some like gimmick here. There really isn't, right? If you want to talk about it with me, if you have more questions, you can call me directly anytime. You can go to our website and schedule a call to speak on a time that works better for you. I'm around all the time. I could talk about this for hours, so don't feel like you're wasting my time. And so it's just something that I want you to consider. So thanks for watching. We'll talk to you soon, and we'll be doing more of this in more detail as the videos go on.